Should you invest in your company stock option plans? Part 2. Hey there, and welcome to part 2 of our episode on Should you invest in your company stock option plans? In part 1, we covered and defined what is a stock option plan to give you the right foundation of understanding your company's own unique stock option plan, because it is really different per company. So if you missed that one, please go back and watch part 1 first. The link to that should be in the description of this video. Now, here in part 2, I'll already share the 3 factors to consider before you choose to participate in your company's stock option plan. You'll also learn how to evaluate if it's a good investment and if it's a good idea based on your financial situation and goals too. With that said, let's begin. The first consideration before you participate is, number 1, are you in a position to invest financially? Because at the end of the day, every stock option plan is an investment because you invest a portion of your money to buy shares which you hope will increase in value in the future. Now, it being an investment, the first question to ask is not, magandang investment ba ito? But rather, are you in a position to invest? Meaning, do you have the right financial foundation already? That means, are you free from any high-interest debts like with credit cards, loan sharks, payday loans, or collection agencies? If no, then the money is better used paying off these loans first, rather than investing in your company stock option plan. Next, do you have at least 3 months worth of expenses saved up just in case for emergencies or in case something bad happens? If no, then the money is better added for your emergency fund rather than investing in your company stock option plan. Next, do you have appropriate life and health insurance plans in place already? If not, getting those taken care of is more recommended than investing in your company stock option plan. Now, to this, some people might be wondering, bakit J3? Wala naman akong kikitain mula sa mga yan. Sayang naman, maganda yung opportunity. Kung sasayangin, pangbabayad lang ng utang or ng insurance or tinabi ko lang for an emergency. Well, if you're thinking this way, it's totally normal. But take note, that line of thinking is also based on short-term thinking. You see, in order to become rich, wealthy, and financially free, one crucial step is to remove the risk of suddenly being poor. For instance, if you have lots of high-interest debts, you are actually wasting money paying off interest. Not to mention the mental and financial stress of being in debt, and that can be distracting you from being able to enjoy life. If you don't have an emergency fund or savings or an insurance plan, then all it takes is one accident, one sickness in the family, and your entire funds can be wiped out, including any investments you made. Or even worse, it can bury you into debt. This is why even if you have an excellent stock option plan, I only recommend to consider participating in it if you already have a good financial foundation for investing. That means not having high-interest debt, having an emergency fund, and having appropriate health and life insurances in place. If you have all these, we now move on to the second factor. How knowledgeable are you with investments? If the answer is not so much or very little, then my advice would be, yes, go ahead and take advantage of your stock options, because this is a great way for you to get started and be familiar with owning shares of stock and being an investor and shareholder of the company where you are working at. On the other hand, if you are already familiar with stocks and equity funds and mutual funds and UITFs, and you've got several of them, then this is the only time I'd like you to evaluate your employee stock option, comparing it with your existing investments. And that brings us to the third factor. Is your employee stock option any good? This will be the bulk of the episode. But again, if you're not in a position to invest yet, please don't invest. Or if you're not familiar with investments yet, please don't get stuck with the nitty-gritty we're about to talk about regarding evaluation. Instead, just invest in your company stock option plan, and that can be your first investment already. With that, if you're in a great position to invest and you're already familiar with different investment types, here is how to evaluate the stock option plan. There are actually just two things to look at. First is to check the guaranteed benefit of participation, whether it's in the form of matching shares or discounted pricing. For instance, if the stock option plan is for every one share you buy, you are given one share as well, that means you get a 100% gain as a benefit. If it's buy two and get one free, you get a 50% gain as a benefit. And we get 50% because one free divided by the two shares purchased, that's 0.5 or 50%. If it's buy three, get one, that's 33%. So one free divided by three purchased, so 33%. If it's buy four, get one, it's 25%. If it's buy five, get one, that's a 20% gain in benefit, and so on and so forth. Now, of course, the higher the gain, the better. But we have to compare that with the duration of the holding period too. For instance, if your company terms say that you can buy four and you get one free, that's a 25% gain, but the terms are it will only be awarded after 3 years, that means your extra gains would be 25%, which is the gain, divided by 3 years, and that leaves you with 8.33% extra. Now let's do another example. Let's say your stock option plan allows you to buy at a 20% discount and the holding period is 5 years. How much are the extra gains? That's 20% divided by 5 years for a total of about 4% per year over 5 years. Now, this number we have, the 4% over 5 years, this is the guaranteed benefit of participation. I use the word guaranteed and extra because this is a benefit that's granted to you and it's guaranteed to happen as long as you meet the terms and conditions, which is usually just based on time. So, what do you do with this number? Let's hold on to it for now and we'll go to the second evaluation, which is on the actual benefit of participation. The actual benefit of participation in the stock option plan will be depending on the performance of your company in the future. Because remember, you're going to be a shareholder here. So you'll purchase at a given price, then you will hope that the prices of these shares go up in the future and not go down. What makes the share prices go up and down? There's a lot of factors, but over the long term, it's going to be company performance and profitability. If the company will continue to grow, then expect your share prices to keep going up. But if it runs into problems, then the value of your investment will go down. Now, without going into too much detail, a simple way to check on where your company is headed is to look at the valuation or the share price of your company over the last 10 years or longer. You can do that by going to Google and typing in the company name and share price, or company name and valuation. Let's do a quick example. I just typed in P&G share price. P&G, Procter & Gamble, a large multinational company. Then I clicked on max for maximum on the time frame so you can see their entire stock prices and you can see it growing over the years. From peaking at 50% per share in the year 2000 to now $120 per share in 2020. That's after 20 years. So that growth is $120 divided by $50. That's 240% growth over 20 years. 240 divided by 20, that's around 12% growth per year if we're just doing some quick math. Now, let's do the same for, say, PLDT. Here, we can see that PLDT peaked sometime in 2015, reaching 3,000 pesos per share, but by 2020, prices per share has declined to nearly 1,000 pesos per share. That's a sharp 66% decline in share prices in the last 5 years. And this shows you that there's still a risk of participating in stock option plans. Now, let's do one more example, and this time for privately held companies, meaning you can't Google their share prices. So, if that's the case, we Google their valuation. For example, let's say you're working for a startup like Canva, one of the world's fastest growing tech companies, and we now Google Canva valuation. You'll see articles released from 2015 saying they were valued at $165 million. Then in 2016, their valuation rose to $345 million. By 2018, they had a valuation of $1 billion. And by 2020, their latest valuation was at $6 billion. Now, just imagine if you were a shareholder of Canva right from the start. Your investment would have gotten a 3,600% increase over the last 5 years. That's 720% per year. Okay? So that's how you check the growth. Now let's go back to what do we do with all these numbers. Let's bring them together. We simply add the guaranteed benefit to the actual benefit of participation. And if the answer is more than 12% per year, then that's actually pretty okay, and that's above average. Let's do a few examples. Let's say P&G is offering a 4-to-1 share plan with a 5-year holding period. So 4-to-1, that's a 25% extra gain. Over 5 years, so 25% divided by 5, that's 5% per year. That's the guaranteed benefit. Plus, how is P&G growing today? If we look at the share prices over the last 20 years, they have been growing at around 10% to 12% per year based on the share price. So 5% as the employee benefit plus 10 to 12% per year for the company's growth, that means you're looking at a 15 to 17% rate of return, which is pretty good. Now, let's do the PLDT example. Let's say PLDT offers a 2:1 stock option plan with a 4-year holding period. So that's an immediate gain of 50% gain over 4 years, about 12.5% per year. But PLDT's share prices over the last 5 years has decreased by 66%, or it has been decreasing by 13% every year. So we take 12%, which is the guaranteed benefit of participation, minus 13% because of the declining share value, and we end up with negative 0.5%, in which case the stock option plan doesn't make sense. Because even if the 2:1 plan is very attractive, the company growth itself is not. So, in this case with PLDT, I don't recommend you participate and maybe instead invest in other better performing companies. Now, please take note that while I used actual company shares here as an example, I have no idea what the stock option plans for P&G and for PLDT and for any other company really is. Those were just made up. We just gave them out here as examples. But I hope that this gives you a framework or an idea on how do you evaluate the stock option plans if you were already in a position to invest and if you are already familiar with investments. With that said, let's do a full recap of parts 1 and part 2. What is a stock option plan? It is an employee benefit where an eligible employee has the option to purchase shares of stock of the company to receive additional benefits like matching shares and discounted pricing, subject to terms and conditions, of course, like lock-in periods and holding periods before you can sell. At the end of the day, though, a stock option plan is an investment. So before we make that investment, we have 3 considerations. First is your financial position. If you do not have a strong financial foundation yet, if you have high interest debts, no savings, and no insurance yet, it is better not to participate in the stock option plan for now. Instead, focus on improving your financial foundation first. But if you already have a strong financial foundation, then go ahead and proceed with the next considerations. The second consideration is your investment knowledge. If you are not familiar with investments like stocks or equities, then go ahead with the stock option plan. Let this be your first stock investment for your learning. But if you're already experienced in stock and equity investments, then we evaluate it based on the third consideration. The third consideration is the stock option plan any good? We take a look at 2 numbers. the guaranteed benefit, and the actual benefit. If the sum of these numbers are greater than 12%, then it would be a good idea to participate. If the numbers are lower than 12%, then investing in other companies or vehicles would be the way to go. And that's it for our two-part series on should you invest in your company stock options. I hope that this video has helped you understand and decide whether or not you should participate in your company stock options. If you found this episode valuable, then I want to share the inspiration behind this video, which is from Canva, one of Australia's fastest growing tech companies and awarded in 2020 as the #3 great place to work in the Philippines. Now, Canva Philippines recently got me to deliver a custom training to some of their employees to also help them in making their financial decisions because they wanted their employees to be equipped with independent financial guidance so that their employees could make an informed choice. And that tells me that Canva truly cares for its employees' well-being, and their award for being a great place to work at is well-deserved. Now, while they invested the premium for the custom training I delivered for them, this recommendation is just a bonus I wanted to make for them because they are empowering their team with financial knowledge. So, thank you to Canva Philippines for caring for your team and for also being the inspiration to this episode on stock option plans.